Hello and welcome everybody. Thank you for being here with us today at this XTB Trading Club. My name is Walid Koudmani, market analyst for XTB, and thank you very much for everybody who's here with us today. We're going to have a very interesting and very packed of information. Obviously, it's going to be filled with information today's webinar. We're going to talk about a lot of subjects. So we're going to talk about what's happening in the markets these days as a general overview, what this whole topic of inflation has been so far, why people and investors in particular seem to be focusing on it. We're obviously going to be touching on the Tesla situation, what's happening with that stock, going into a bit of analysis on that, the fundamental factors as well as some technical factors. And then we're going to do a brief commodity overview where we're going to take a look at some energy commodities primarily, but obviously we can move on to precious metals as well. So thank you to everybody who's here with us so far. My name again is Walid Koudmani, market analyst. This type of event obviously is more interactive. So if you have any sorts of questions, I have access to the chat on the right here, and I'll be able to interact with you as well. So if you have any questions, feel free to ask them. If anything is unclear, feel free to ask that as well. I tend to have a question and answer section towards the end of the webinar anyway, so shouldn't be a problem. Before we start, if we could get a quick audio video check just to make sure that everything is working correctly. So let me just take a look at the stream. As I can see, everything should be working fine. So thank you to everybody who's here with us so far. Yeah, so I'm going to mention that, but we're going to talk about a lot of topics. So if anything interests you particularly, feel free to ask a question. If anything is confusing or unclear, feel free to ask a question about that as well. But yeah, besides that, we can probably move on. I think I can get a confirmation on the audio video. Everything should be working fine. And if you can see my screen, we should be able to move on. So as always, the disclaimer, this presentation is provided for general information and marketing purposes only. As always, do your own research. This is a risky asset, as always. Please be aware as well that information and research based on historical data or performance does not guarantee future performance or results. And 73% of retail accounts, investor accounts, lose money with CFDs. So now that we've covered that, we can move on to some top news, what's been happening in the markets. We're going to take a look at gold as well as bonds. We're going to take a look at the stock market. We're going to take a look at stocks, indices, and the main topic that has been in the markets as of late, which has been really, we've had the rise of energy prices that impacted the markets. In fact, you can check out our previous webinar we did on that, on the energy crisis and how turning that potentially into opportunities. Today, we're going to be focusing more on the inflation side of that and how that is impacting stocks and precious metals in addition to other commodities. And as I said, we're going to be focusing later on the Tesla situation, covering what Elon Musk has been doing, covering what the stock itself has been doing. As always, these are interactive events, as I mentioned, so if you have any questions, feel free to ask. But in the meantime, we'll just keep moving forward. So US inflation so far has been benign, so positive for stocks. Gold rallies, even though US dollar has been moving up. So we've seen the US dollar push other currency pairs significantly down today with Euro USD ranging around 113. We haven't seen that level in quite some time. So US dollar, traditionally, that's not what happens. Traditionally, you would have a generally inverse correlation. So as the US dollar goes up, the gold price goes down. But at the moment, we're seeing an increase of both, in part driven by inflation as well, because gold seems to be sometimes considered a hedge against inflation. So that can be a sort of investment for more cautious investors, let's say. Markets expect not sufficient reaction from the Fed in remarks from Harker, which is a Fed member. Fed should not overreact or Yellen. Inflation is caused by COVID. Do not suggest sudden policy change. So even though we have been told many times that inflation has been considered transitory or temporary by the Federal Reserve, in particular Powell, what we're seeing is indicator after indicator, month after month of inflation increasing. Obviously, that is having a significant impact on the economic recovery post-pandemic, and we are seeing the central bankers downplay it. So that is leading to the thought that maybe we might not see a sudden reaction by the central bank, as we have seen from other central banks. There's a storm of FOMC speeches this week, so we had a few today. They're always worth keeping an eye on because sometimes, especially in recent times, even central bankers mentioning a certain event happening or the potential of something happening has an impact or has potentially an impact on the market. So because of that, it's worth keeping an eye on the general fundamental news that affects the markets even before you're looking into the market. Chinese data output. So Chinese data has been really under more focus since the beginning of the pandemic and the economic recovery, because they were the first country really to majorly recover. And output is at 3.5%, sales at 4.9% for October, a notch stronger than expected after a very weak September. So we are seeing a recovery in the second economy of the world as well, which is huge and very, very important because, as we've discussed in previous webinars, China, not only are they a major supplier, but they're actually a major source of demand for a lot of raw materials, including, I think, if I believe correctly, if I remember correctly, around 50% of the world's copper is imported by China. So you can see how the economic recovery in China is important for other countries as well. So I can see a few other people joined us. Welcome, everybody. Thank you for being here with us at this XTB Trading Club. Once again, my name is Walid Koudmani, market analyst for XTB. And this is an interactive event. So if you have any sort of questions, I do tend to have hold a Q&A section towards the end where we can just look at the charts or look at the X station. But if anything is unclear, or maybe something is you're not too sure about, feel free to ask and I'll try to answer the question as much as possible. Here on the right, we can see on the X station chart, gold prices rallied despite stronger dollar and higher bond yields, which is not as traditionally as it's seen. And we are keeping an eye on inflation. Inflation keeps putting pressure on the Fed. The last time inflation rose like this was in the 1970s. In October, the increase was driven by fuel prices, but also other categories. So that's something to keep in mind. Inflation is the measure of the general cost of living and the spending power of the currency. We are seeing multiple sectors being affected by that. Now, how much of it is driven by oil itself and energy is debatable, but all of these factors are starting to factor in as well. And here you can see the contribution of yearly inflation. Obviously, transport and motor fuel is at the most. Housing and shelter is higher as well. Transport for private, and then we can see here food, beverage. So everything really across the line. The only thing that's kind of lowering is public transport, and communications really haven't moved that much. But broader inflationary pressures are evident. Fuel and used car prices are still sitting in inflation, but the contribution to the other categories is growing. Even without the two most important ones, inflation was already exceeding 3%. So the average target for the bank usually is around 2%. So that is the average target. At the moment, we're seeing above 3 and even above 4 and 5. So prices of some raw materials such as coal and iron ore have recently fallen sharply, but some signs of inflation taking root are already visible. So we saw actually a move from coal more into oil as well. The strengthening of the dollar and the simultaneous rise in gold prices show that the market is not convinced that the data will change anything in Fed policy. That was something that was keeping investors on edge, was the likelihood or eventuality of the Fed actually making a move at any point in time. It seems, though, that they have downplayed it enough to where investors are starting to think, and markets are starting to think, that the Fed will not react. They will set out a plan and then kind of make minor adjustments rather than actually change based on some significant data. Story of the week is, can we call the top of the market? So we've seen some moves on the markets as well. They'd be very important, but let's see what is the situation at the moment in the markets overall. What we're seeing, this is a comparison of all different indices we have, or many different indices. We have DAX, US 500, US 100, the Spanish index, French, Polish index, and a couple of ETFs as well. So despite the number of potential risks, Evergrande, the energy crisis, and inflation, September brought a slight pullback, after which the indices, especially in the US, moved upwards with momentum. We talked about the possibility and reasons for such a move in the previous webinar. Nevertheless, when contrasted with the fundamentals, many investors are asking themselves, is this a prelude to a crash? So this is something that I've talked about in other webinars as well. Really, the mismatch between the index performance and the actual stock performance within the index. I think we're going to touch on this in several slides down the line, but basically the issue is that these indices, especially the US ones, because if you look at the green line here is the NASDAQ index. So the tech index is actually carried by just a few companies, even though there's 100 of them in there. Same with the S&P. If you look at the weighting of these indices, they are being moved massively by a small number of companies that carry majority of the weight in them. So what are those companies, you might ask? The companies are basically the FANG companies. So Facebook, Amazon, Netflix, Google, and a couple of others. Tesla nowadays as well. But at the same time, the important thing is that the index itself is seeing signs of recovery even moving into the end of the year, where we had seen potentially inflation could have a negative impact on the indices. So it's in a very interesting situation where inflation in itself could be considered negative for markets. However, because a lot of these stock markets are, let's say, inflated by the excess liquidity that the Fed has provided. So, by what I mean by that is low interest rates and quantitative easing. So, ironically, markets are likely to react, or potentially could react, to the announcement of that changing rather than, let's say, an increase in inflation, which is a more practical change. So, an increase in inflation really decreases spending power of the population. However, what has been going into these stocks has not been just general money, it has been a lot of cheap money. So that is the key factor, I think, one of the risk factors that a lot of investors are keeping an eye on, not necessarily inflation at this point. So again, if anything is unclear, feel free to stop me. Record-breaking Shiller PE, so price earnings, will work for the third time. We have here on Exhibit 4, expensive valuations after the bull market and everything similar to gold in 1920s and 50s. Shiller PE for the S&P 500, accounting for cyclical earning, climbed to levels previously seen 2 times before major crashes. However, there are also many crashes that this indicator has not warned about. So we're going to be taking a look at a couple of indicators that have been used in the past to assess the situation when markets are moving very high, to, let's say, preempt a crash or to see if there's an incoming crash. However, the key thing to keep an eye is that even though these indicators do tend to work sometimes, there's other times where they don't. So keep that in mind whenever you are using any sort of indicator as well. However, yeah, as you can see, the problem of indicators is lack of regularity. Most measures based on historical price earnings ratios or simply on trend indicate record overvaluation. They all have one common problem, lack of regularity though. Looking at the chart on the left, in 1997, an investor would have already considered the markets historically overvalued and sold stocks 3 years before the peak. So this is a different kind of market we're entering, or we are finding ourselves in at the moment. Maybe traditionally speaking, you may have heard of bubbles, like the dot-com bubble or another, the housing crisis, for example, as well. What we are entering or what we are experiencing oftentimes can be seen as something like that, where yes, absolutely, certain companies are absolutely worth perhaps their money. However, if we go and look at each stock individually, we'll see that in these indices, in particular, a lot of these stocks are overvalued when you count the actual performance. So what I mean by that is for example, a stock like Tesla, which we're going to get to later on. Now, could it be worth $1,000? Absolutely. Could it be worth 1,200? Could it be worth 500? That's the thing that's really important to keep an eye on. Is it justified that a stock like Tesla is worth more than the entire automotive, or a company like Tesla is worth more than the entire automotive sector of Germany, when they don't produce nearly as many cars yet? So these are the things to consider when you're looking at a lot of these markets as well. Is how solid is the backing of these stocks? How solid is the backing of this index? Is the move itself, let's set aside technical indicators for a second, is the move itself in an index justified by good performance by the underlying assets within the index? Or is it just speculation? Is it just easy money? Is it just, let's say, cheaper money from the lower interest rates of the central banks? So where is this cheap money going? We have seen that really in the regular economy, obviously some of it has gone into consumption products, but a lot of it has gone into stocks. We had crypto as well take a part of it at the beginning of the year. We saw that. But really, investors are seeking somewhere to put that money, because traditionally speaking, it is not going to be worth it to save it with a very low interest rate. And that's what we're seeing as well with precious metals. A lot of money has gone into precious metals, not as much as other assets at the moment. But again, keeping up with inflation has been the key subject for a lot of traders and a lot of investors, because they're realizing that with very low interest rates, it's not going to keep up in the savings account with a 0.01 interest rate when the inflation rate is at 5%. So that's what investors have been looking at. However, with these stocks and with these indices, it's important to keep an eye out that even if you use an indicator to calculate, sometimes they do lack regularity. So many data series do not have a long history as well. That's something to keep an eye on. Here we see an indicator based on profits for the last 5 years, sales for the last 12 year, and expected profits for the next 12 months. As we can see, the level is close to the peak of the dot-com bubble, but the history is very short, and this level has been recorded for a good few months, during which we have a very strong bull market. So something could point to a potential to reverse, but then it just keeps moving forward even despite that. So again, with indicators, keep in mind that even though they could be showing something, they are indicators, they're not predictors of the future, and therefore always important to do more research or to be more convinced. Also, expected returns are very much a subjective indicator. It seem that based on the expected results, we would get very objective indicators. This is, however, not the case because the bull market is causing analysts to raise earnings estimates for companies to get their models right. So because the earnings and the basically the valuation of these companies are not matching at the point anymore, where you'll see that the price to earnings or price to sales ratio is way off compared to what it might have been in the past. And analysts at this point are just adjusting their targets and their ratings based on what's happening in the markets rather than the actual, let's say, objective, as you can see, expected returns data. Throwing away expected returns, we get the most overvalued market. We can see that throwing out expected returns improves the indicator slightly and extends our track record, but still the indicator is only indicative. The bull market of 2003-2007 runs with a flat indicator, which did not warn us of all the deep breakdown. Even looking at 2000 and 2020 and the present, what level of the indicator is already a so-called sell? It is not clear. So again, when we're looking at these indicators, particularly in a skewed market as we have it at the moment, where all these, let's say, quantitative easing, as I said, low interest rates have favored markets and have favored stocks by providing cheaper money to the market, how much of it is going to be, let's say, readjusted in terms of performance once that does change, which is why, as you can see, as I've hammered home several times this point in several webinars of why is it that inflation is so closely paid attention to? Why is it that the central bank decisions have become suddenly so important? Even their speeches nowadays, even if they don't take a decision, it's so important. It's exactly for that reason. It's because, well, one of the reasons in particular is the fact that this, any change, or let's say the interest rate change by the central bank or the QE change by the central bank, that then goes and affects the money directly available to the market. And that money, as we have seen, the distribution has been heading into stocks as well. So that's the key here. Hopefully everything is clear so far. I'm trying to move a bit quicker. There's obviously not that much to talk about on these slides, but I'm trying to move quicker so we can get through these slides, get to the Tesla section, get to the commodities section, and then get to the Q&A section. If you have any sort of questions, we can even look at the charts and move on from there. So let's take a look at a couple of interesting indicators. An interesting indicator based on profit deviation from trend for a good few months now. However, at the sell level, again, we are seeing a lot of indicators which traditionally maybe may have made sense to have these at these levels. And if you look at tangible factors, yes, okay, maybe these markets are overvalued, but it doesn't seem to matter at the moment. So investors still have faith in these projects, still have faith in these stocks. How much of it is speculative? How much of it is legitimate? I wouldn't know how to tell you that on the sense of like how many of the people that say that are investing in Tesla are actually doing the research and how many of them are seeing the price go up and then buy. But obviously, as we have seen just recently, some of the people that did end up buying without doing their research then obviously lost up, especially if there were CFDs, let's say, they incurred some losses recently if they were long because of the fact that, fundamentally speaking, something changed. Secondly, we have a couple of other indicators. Bull market since the 2-year low. Usually the peak was in the vicinity of 65 to 80% or shortly after going down from these levels, currently already exceeding 100% here on the bottom, you can see as well. And this is another key factor. Overextension is the theme here. Indicators using consumer and individual sentiment, so consumer board and ISM. So these are something we do report on the news section as well, so feel free to keep an eye on that. Work as a rule, according to the idea, an overheated economy is the peak of the bull market, but it usually warns too early and the levels can vary greatly from 115 to 1.45. Again, rising prices, consumers having negative expectations, and as I said, industrial sentiment fluctuating. That's something that always worries markets because it could lead to a different set of approach, or a different approach by the central bank itself. So as you can see, it all ties into each other, and this is a point I'm trying to stress, how these three things tie into each other. Economic performance of the, let's say, of a country in particular, let's say the US, what the central bank is doing, and what inflation is doing at the moment. Annual change in debt for equity purchases as well. So far, the 60% level has been guaranteed signal, quote unquote. Nothing is guaranteed, but this year it was reached in February without effect. Again, once we are using indicators, they're not confirmation signals. They're really not predictors. They are, let's say, something we can use. Well, I would consider them more of a confirmation, but again, as we can see, we could have something that is traditionally guaranteed, and yet at this point in this market, we are seeing it not be guaranteed. Home construction versus population versus average, another type of indicator. Also put call options on the 21-day average. These indicators also seem to tell us something, but they themselves are low signaling accuracy. So as you can see, we have used about 6 or 7 indicators at this point, and a combination of all of them is something worth considering. Fundamental analysis is something worth considering, and obviously technical analysis is also something worth considering. So as I said, perhaps the behavior of the price around the peak is something worth considering as well. Looking at historical crashes, the behavior of the price around the peak could vary. We've had bad periods of rapid rise combined with rapid fall, so in 1929 and in 87, as well as really mild peak, but never has the market fallen from the peak. That's something worth keeping an eye on because of the fact that a huge drop from the peak could be something similar to what we saw really with the beginning of the pandemic, but that was caused by an extreme factor that then we ended up seeing a V reversal in many indices, particularly the US. So question is, can we identify a peak? There is no single indicator that can predict the moment a bull market peak with high probability, which probably should not surprise us. There are many indices that historically before crashes have reached values far from their averages, but usually the scale of these extremes has varied and their occurrence incomplete. Currently, the market seems to be extremely resistant to historical correlations. Theoretically, we can combine these indicators to look for a pattern that will work as a signal. But it is very easy to make the mistake of overfitting, which means looking for an indicator that fits the story and does not work in practice. Indicators can be used as an aid, although then their objective character is lost. So again, as we have touched on in the past and as we are talked about today, the key thing is that indicators can be very useful. Data can be very, very useful, and it's very important to follow all of that. But however, we are seeing it is important to keep an eye on the bigger picture. So one might ask, why is it that these indicators, especially now, have not kind of met, let's say, met the expectations that they had in the past? So maybe they were a little bit more accurate in the past, but now in particular, we are seeing a huge divergence from all of these factors. And one of the theories that we put forth, and one of the things that we've discussed in these webinars, and really from the beginning of the pandemic, has been the excess liquidity and the excess money that has been going into the markets. Particularly, I don't want to say particularly in the US, but that's a good example because that was where the indices really rebounded the fastest. But also because of the fact that we have seen that happen throughout a year and a half, and we've covered it throughout, where a lot of these stocks, when you go and identify their performance, when you go and identify their price to earnings, when you go and see their price to sales, then you go and see that they are worth, multiple times more than that when it comes to the evaluation of the stock. So the question that leads to is, when that money is removed from the market, when that cheap money with 0.01 or 0.1 or 0.2 interest rate is removed from the market and interest rates are back up, QE is reduced even further, and then the market is left to itself, where will we see a rebalancing of these stocks? Will we see a rebalancing of the stock indices? That is something that obviously I cannot predict, but it would be an interesting thing to look out for in moving forward. Traditionally speaking, nothing keeps going up forever, but traditionally speaking, also if you look at the S&P 500, let's say, index over the last 40 years, it's basically moving in one direction. Yes, we have had corrections, but traditionally speaking, that's the case. So again, we are seeing a unique set of circumstances at the moment with the amount of money that has been printed, and we've covered this many other times. But that leads us, maybe if we don't know what's going to happen at the moment, we can start asking questions of, okay, so if we remove this variable and this variable, how does the market fare on its own? And that's the key question, I think, to ask. So what is happening with Tesla? That is also a key question to ask, and that is, I think, what many of you may be here for. Tesla, a company that has become much more famous with as of recently, I would say last few years. moving forward with the technology, moving forward with the electric vehicles, really pushing it forward for many. The industry moved forward because of Tesla. However, what we are seeing is some obviously extreme moves with Tesla over the last year or so, where the price really escalated a lot. But now we have had a brief, or not brief, but a significant, let's say, correction in Tesla that many of you who may be following the news or have followed the news may have heard of the Elon Musk tweet, but let's cover it just in case. So Tesla had the worst 2-day decline in 14 months. The question is the bubble bursting? So here we can see a tweet by Elon Musk on Twitter. Much is made lately of unrealized gains being means of tax avoidance, so I propose selling 10% of my Tesla stocks. So this was a survey on Twitter saying yes or no. The answer was yes, and he said that he would abide by that ruling. So he actually did. He started selling his Tesla stocks. And the one thing to keep an eye on, though, is that Elon Musk is known for his PR stunts and rather chaotic Twitter activity. What may tell us more are actions by other board members of Tesla. So this is something that really I wanted to touch on today. And if anybody here is trading Tesla, obviously do your own research as always. Anything we talk about is not investment advice. There's significant risk in anything you do investment-wise. But keep an eye out for the news when it comes to these stocks. So Robin Denholm and Ira Erpe and Antonio Gracias sold shares worth hundreds of millions of dollars since the end of October. These are board members of Tesla. Sales of stock by executives are closely watched by investors, so that is something to keep an eye on, because executives within the company, sometimes they do hold their own stocks, but sometimes they do have, or they could potentially have, some information that most of us do not have. But really, what really looks even more interesting, I think the point here is a regulatory filing by Kimball Musk, one of Tesla's board members and brother of Elon Musk, who, according to the filing, sold $109 million worth of Tesla stock, which is 15% of his holdings, on Friday, November 4th or 5th, a day before the Elon Musk launched a Twitter poll. So here we said that his PR stunts and chaotic Twitter activity, but sometimes we tend to think that maybe it's a little bit more impulsive and more natural, let's say, in the moment. But as you can see here, it is possible to assume that these people were aware of what was going to happen. So if you're trading a stock and the owner of the company is actively disclosing that they're going to be selling something, but they tell somebody else first, that's obviously something to keep in mind when you're doing that. Options are in play again as well. So these are things to consider. As you see, as a large number of traders buy call options, market makers who sell those options need to buy underlying stock to hedge their positions. Options often trade at a fraction of share price with contract size equal to 100 stocks. So this is traditionally more of a US type of trading, where we in Europe, let's say in other countries, we're more favored toward CFDs and that kind of trading. In the US, they tend to prefer options, which are calls and puts. However, market makers who want to hedge their positions need to buy underlying stocks at full price in respective quantities. This means that a small investment in options by a retail trader often leads to a large investment in an underlying by the market maker, creating a massive upward pressure on the price. However, this works, of course, both ways. Should market makers have a large short position on put options, they would want to sell underlying stock to hedge this exposure. In such a scenario, a strong downward pressure on share price may appear. So really, we can see with these calls and puts is where the majority of the interest becomes, is where the price tends to get pushed sometimes because of the underlying interest that these market makers are selling. So if I'm a market maker and I have the financial power to drop the price of an asset, because a lot of my clients are selling it, so that's something obviously worth considering as well. And here you can see on this chart by Bloomberg, Tesla option trading volume since the beginning of July 2021. You can see quite stable, and then this spike here on the call volume, and then nowadays put volume and call volume are both up, pushing the price really into volatility. But the key is the bubble bursting on Tesla? So here we have the daily chart, huge drop, obviously from around 1237 to around $1,000 Shares of Tesla are often labeled a speculative bubble. While the company has started to generate profits after years of cash burning, its valuation remains sky high. Tesla trades at a price to earnings ratio of almost 300. Current price is also 21.2 times higher than sales per share for the past 12 months. To put these figures into context, the S&P 500 trades at a PE ratio of 25.8 and a price to sales ratio of 3.13. So you can see here 25.8 compared to 330 and 3.13 compared to 21.2. Given such high valuation, a correction should not come as a surprise. However, it does not necessarily mean that the bubble is bursting. Tesla is very volatile stock, and volatility works both ways. So we can see that the price gets pushed down significantly fast and the price gets pushed up very, very fast as well. So when it comes to trading anything that has really any volatility, it's always important to be cautious, even more so when we're trading something like this. A look at Tesla here on the chart shows that the decline still has quite a lot of room to deepen, because we have this area in the past, really before the gap. Key near-term support could be found around the 50% retracement of Fibonacci retracement of this year's upward move in the $900 area. This zone is additionally strengthened by the lower limit of the market geometry. So here we can see that an equivalent move to here, along with the 50% Fibonacci retracement. So around $900 an area to keep an eye on. But once again, we saw that basically from the beginning of from the end of 2020, it took until October to reach that level once again, and then we saw this huge jump. But besides that, as I said, these are the figures to keep an eye on for Tesla. Elon Musk and his tweeting, this is similar to what we discussed in the past with the Trump effect, where he would tweet something and then markets would panic, or something would happen to the markets, whether up or down. It does add to the volatility and unpredictability of the markets. We can do all the technical analysis we want, but if Tesla does that, there's not much we can do. But something to keep an eye on, again, on the macro picture, we had Tuesday's U.S. retail sales and industrial production, which were both above expectations. Nevertheless, the most relevant speeches will be those by FOMC members. We will have an opportunity to react to inflation data, and in context for stronger ones, also the NFP. Will they finally signal action, or are we still in for a fairy tale of transitory inflation? As I mentioned at the beginning, many central bankers have declared that inflation is going to be temporary. It's going to pass on its own, but as we see with data every month, it's really just increasing. There are a minimum of 14 speeches between Tuesday and Friday, and while Powell is not among them, the speeches should pretty much capture the mood of the FOMC. As I said, even decisions not themselves are important, but even their speeches are important because they can indicate their outlook and their view moving forward. Now, let's move on to a quick commodity overview. As always, as I mentioned in the past, thank you to whoever is still with us right now and whoever joined us. If you have any questions, feel free to ask. I have access to the comments here on the right, so I can touch on any market you're interested in. I can pull up the charts as well. After this, we can look at the X station. Just a quick commodity overview. Take a look at a couple of commodities, fundamental factors, and then we can move on to the charts if anybody has any questions, or we can just end the webinar at that point. So oil has been a key market for quite some time. We saw some excessive volatility or increased volatility not too long ago. A lot of demand concerns, or rather a lot of supply concerns, as demand keeps increasing. But we have seen here OPEC members, which are Saudi Arabia, Oman, and United Arab Emirates, do not see the need to bring back oil supply at a quicker pace, as they expect a drop in oil demand at the end of Q4 and the beginning of Q1 2022. So at the end of Q4 2021 and the beginning of 2022. We also saw Russia join core with the voices opposing U.S. pressure on boosting oil, and also Russia is pointing to a potential oversupply at the beginning of next year. So we have these two conflicting narratives at the moment on the oil market. We have really the U.S. Trying to push for an increase in supply from OPEC and oil-producing countries, like Russia, for example, on the need of, let's say, rising demand and lower inventories. But at the same time, we are seeing the counter narrative by these OPEC members saying, no, we expect demand to drop towards the end of the year, and we expect supply to catch up, in a sense. So this was something that has been followed for a while, OPEC decisions, where they decided in particular to leave production increases fixed at 400,000 barrels a month of an increase. That did see a significant price reaction from oil in particular, and as we were heading into October and those months, September, October, we saw a lot of effects of that on the actual consumers, with gas prices reaching record levels. We saw oil prices reaching multi-year highs as well. Now they are starting to pull back slightly, but it does not seem like we will be seeing an increase in production. Here on the Bloomberg chart on the left, we can see U.S. inventories grew at a slower pace than hinted by seasonal patterns. So here we see the 2021 line. It is the orange line, and it is below, as you can see, the average, which is this dotted line. So what the U.S. is potentially going to be doing is releasing some of their SPR, so their strategic petroleum reserves, which are, let's say, reserves used in case of shortage of supplies. So on one hand, we have the U.S. asking for more supply, and on the other hand, we have the suppliers saying we think demand will catch up. But in the meantime, we are seeing this increase in prices. So obviously that is having a huge impact on a large number of industries. So as you can imagine, oil prices, energy prices do end up impacting the broader market as a whole, and therefore are a key thing to keep an eye on as well. Secondly, the Biden administration explores possible option for lowering gasoline prices, including releasing strategic petroleum reserves. The impact of such actions is expected to be short-term only, because that would be only able to be done, like at a certain point, and then that's it. U.S. oil inventories increased at a slower pace than hinted by seasonal patterns as well. So we are seeing some supply concerns from that end. And gasoline inventories are approaching a seasonal low, incoming end of maintenance works at U.S. refineries should boost availability of fuels. So sometimes what doesn't go and impact supply is natural events. We've had hurricanes, we've had several events shut down production of oil across the world throughout the pandemic, but really in particular past few months as well. And that has been leading to some undersupply as well on that end. But you can see here on the Bloomberg chart, once again, the orange line is U.S. gasoline supplies in 2021, and the average, once again, is here, as you can see, significantly below the average on the Bloomberg chart. Past that, we have natural gas, which has been a major topic of discussion as of late. Not so much maybe in the last few weeks, but definitely when we did the webinar on energy crisis. You can go and check that on the YouTube channel. And of course, if you have enjoyed this video so far, feel free to leave a like, subscribe to the channel for more content, leave us a review on Trustpilot, or follow us on our social media. And again, thanks again for being with us so far. Once again, if you have any questions, feel free to ask. I've received a few in the past, so obviously I'm always happy to answer. But let's take a look at this chart here, and let's take a look at these figures. Natural gas prices in Asia and Europe resume upward move amid lingering uncertainty over Russian gas supplies. Uncertainty over gas flows to Europe via Belarus amid migration crisis on the Poland-Belarus border. We saw Putin spoke with Belarus Lukashenko about natural gas deliveries to Europe via Belarus. We saw that actually one of the things that managed to cool off the price of natural gas at one point a few weeks ago was the announcement by Russia that they were going to be increasing supply to Europe to make sure that they were not going to be undersupplied for the winter months, as obviously demand season increases. Temperatures on U.S. East Coast and the U.S. Northwest at the end of November are expected to be below average for the period, which is expected to traditionally increase demand for natural gas for heating. Demand for natural gas is 12% higher than last year. However, the amount on gas transferred to LNG terminals is declining, which can be reasoned with higher domestic demand. And here we can see on the left, heating season in Europe has begun and inventories on the old continent are falling. So we are seeing that heating season has begun. There's going to be an increase, or there is an increase in demand for natural gas. We are supposed to be seeing an increase in supply from Russia. In the meantime, obviously, we are seeing the inventories drop in the old in Europe. And so a key story that was really the headline a few weeks ago has become kind of a side story nowadays. But as you can see with the projections that we are seeing, with the lack probably of increase in supply from OPEC, with the issues we are seeing between the Poland-Belarus border and several perhaps issues with the Russian gas supply, we could be seeing a potential continuous decline in inventories in Europe and in the US, unless, of course, we do see an adjustment of demand as OPEC is predicting. So that's something to keep an eye on as well. as we head into really the final stretch of the year with the increase in demand for these heating resources and energy. And I think one final one would be coffee, which is something that maybe is not kept, not many people follow, but is an interesting commodity to follow because it's a seasonal commodity as well. Coffee prices reached the highest level since 2012. Poor outlook on Brazilian and Vietnamese crops suggest slow rebuilding of inventories this week. However, the price gain on the coffee market are not only related to output issues, but also to issues with deliveries. And cost of deliveries increased several times since last year, which may trigger a significant price increase for both coffee traders and end users. Again, cost of deliveries, we can go back tied to these things where we talked about these factors on oil and other markets as well. Coffee prices, you can see here on the chart on the X station on the left, this is the weekly chart, continue to climb higher amid output uncertainty and high cost of deliveries. In turn, the availability of coffee may be limited in some parts of the world. It should be noted that net speculative positioning is sitting at extremely high levels. Price has not broken above the 61.8% retracement of the 2011-2013 downward move. So once again, just to recap what we talked about, coffee prices, highest level since 2012, being pushed up by higher costs of deliveries and higher costs of production as well, and poor outlook of crops moving forward. And so that's really it for the general presentation of today. Let's see, we've been talking for quite some time, so I'm going to leave the last maybe 10 minutes to a question and answer section. If anybody has any questions, feel free to ask. It can be anything we talked about today. Obviously, we were talking about Tesla. It could be about a market that interests you as well. So I can pull up the X station chart. And of course, thank you for being here with us so far. Once again, my name is Walid Koudmani, market analyst for XTB. And yeah, if you enjoyed the video, if you enjoyed the webinar and these kinds of events, feel free to leave a like. But yeah, I'll just open it up to questions. If you have any questions, please feel free to write it in chat, and I'll have access to it here on the side of the screen. If you have a market that interests you, we have the platform as well, the X station platform. I can show you some charts as well on that. But yeah, thank you so far for being here with us, and hopefully everything was clear, easy to understand, and made sense and related to each other. Really, that's the goal. So I'm just going to be awaiting maybe a question from the chat here. Okay. Let's see. If we have no questions, that's okay as well. We can end the webinar at some point, and then after that we can meet up in the next one, and hopefully, obviously, we'll be covering some major topics as well in the next webinar with Elon Musk and with Tesla, and we'll be catching up on everything we talked about as well today. So, Leslie, thank you very much for your question. Leslie is asking us, what is your analysis on Aud Jpy? And then Willington says, let's view the Germany 30 chart. Yes, okay, we can do both of those things. So let's take a look. I'm going to close this, go here. So this is gold with the US dollar index. But let's take a look at, let's start with the DAX, and then we'll go to, just because I have it open here. So DAX really pulling back from an all-time high. You can see here, reached actually today an all-time high. We touched on this today in the news section. At the moment, price testing the 21 EMA and 8 EMA, so purple line, yellow line. As you can see, the first thing I like to do on a chart really is just draw some horizontal lines to keep an eye out for potential ranges we're trading in. So this is on an hourly chart. You can see I'll draw maybe like a red one here as a low. So we can see that really the index was hovering in has moved from range to range, is what we've seen in the past. So we saw the German index hover in a range between 15,990 and 1680, about 100 pips up and down, breaking above it, then testing it as a support. And then we saw this significant upward move, which if we go and trace it here, about 1.2%, all-time high, and then a pullback. Pullback 0.3%, testing, so you can see price reaction area, around 16,200 points. Again, once again, coinciding with this yellow line, which is the EMA, exponential moving average, 21 periods. And then one more push higher, breaking through the previous high, which is this. Let's say, put it this way, so it's more. And then, as you can see, actually very interesting to note, We'll draw this line right now. So pushing past the previous high and then reaching a new all-time high, pulling back, now testing the previous high, which acted as a attempting to act as a support. Obviously, the day is almost over with the stocks, with the European session, but interesting to note as we head into the end of the week that we are sitting potentially testing a previous all-time high as a support at the moment, very, very close to the other all-time high as well. So at the moment, testing 3 indicators and an all-time high after an upward move. But as you can see, significant upward move. So we with an RSI of around 55, we are seeing a very interesting technical situation at the moment. If we go and take a look at the news section, we can see here that we touched on it today in the article on the DAX reaching an all-time high, and we saw some company news as well, which was mixed. But yeah, moving forward, heading into the next few days, let's take a look at the economic calendar, what we can expect tomorrow. We don't have anything from Europe, and then on this week, we have Friday. We have some European central. We have some news on Friday, but minor, basically. So it's going to be interesting to see what the Germany 30 does. But it's sitting at a very interesting level at the moment, so worth keeping an eye on this level at the moment. Hopefully, obviously we're not giving investment advice, but this is a rough analysis of where we are sitting at the moment, testing 2 averages, testing a previous all-time high, which was broken quite quickly, but then pulled back and acted as a support. And we are still hovering in a very narrow range, really close to the all-time high that was just reached. RSI as well, as I said, 56, so not in overbought or oversold territory. Let's take a look at now the analysis on AUD JPY. So interesting pair we have here. We see AUD JPY is Australian dollar yen. So I'll actually just pull it up somewhere around here. Significant drop on the AUD side of things, as you can see, breaking past a structure point from the past. Actually, let's draw it as a rectangle even. I like it as a zone. And then heading down from this. So we could see a potential here formation where we saw lower lows and lower highs before a pullback. Now, key thing to keep an eye on is that at the moment we did break through the previous low, and now we are trading at the lowest level since, as you can see here, about the about a month ago, so the 10th or 11th of October. Key thing to keep an eye on also, the price did rebound from here. But when it comes to these pairs, the interesting thing is that they're interesting currencies in the sense that the Australian dollar is a currency that traditionally seems to be tied to commerce in the country. So exports and imports, the economic performance of the country. As we have seen, Australia has been struggling with several factors. And then the yen, which is traditionally seen as a safe haven currency. But really, let's take a look at what's happening with US dollar yen, just to compare a little bit on daily. We can see that even US dollar yen is pulling back significantly, which means we can go and assume that if I go and look at the market analysis section here, we're going to be finding a yen that's performing very well. But let's see what happens. So this is the heat map here. And we can see yen performing strongly against all currencies today. So it's not exclusive to the Australian dollar. As you can see, 1.1% against Canadian dollar as well. Euro, USD, all performing negatively against the yen. Even though they're actually performing respectively well against other currencies, it's just the yen itself that's acting very strong today. And we can see that in every currency pair with the yen. And with the US dollar yen, we are sitting at a previous level, which we can trace around here, 114. While for, as we mentioned, the Australian dollar yen pair, we are sitting below a previous level, and at the moment just hovering in a, you can see this prior to this upward move. But let's go on to maybe a longer term time frame and see what's happening as well. So this is on the daily chart, massive daily candle. As you can see, probably should be around 1.1%. Yeah, 1.10. This area we're hovering in, as you can see, acted as a support several times. for the recent move, but before was unable to break through the upper limit. So that's what we're seeing at the moment. On the daily, though, it does paint a slightly more interesting picture because we can see that this area was actually a price reaction area in the past, tested as a support once, and then broken through in the past, where it led to a significant downward move when this level was broken. However, on the flip side, when it did get when it was broken on the flip side, we saw a potential here double top, which you maybe hopefully it's clear enough. You can see. Let's see if I can do this on kind of like this. As you can see, 1, 2, and then on the break here, we saw a retest of this area in the past. So both currencies sitting at an interesting level. However, today is really being pushed by yen's strength on the back of these moves. But let's take a look at what is relating to that. If anybody else has any other questions as well, feel free to ask them. I have access to them in the chat. We can take a look at the charts. We can take a look at other charts as well. So really, this is one of my favorite parts of these events where I get to interact with our clients and our viewers. So if you have any questions, please don't hesitate. I'm here to help or do my best. Obviously, I can't give financial advice, and nothing I say really is financial advice. So do your own research always, but I do like to give my perspective, hopefully clarify certain things as well. Besides that, though, as I said, sitting at a very interesting level on Australian dollar yen. Keep an eye out for the fact that yen has been outperforming everything else, and Australian dollar has been underperforming everything else. So really, it's the worst to the best today, in a sense, to where like one of the worst currencies is trading against one of the best currencies, and this is the kind of candle that we end up seeing on the daily chart, where it took 1, 2, 3, about 3 candles to reach this level around 83.8, and then we saw the significant pullback testing this area, which, as you can see here, is past this previous support. But really, if we go even further back to July, we can see this area was attempted to hold as a support, kind of managed to a few times, but then after being broken through, we saw a significant decline. So when we look at levels, it's important to keep an eye out for key levels and what that can signify in the future, because we might not have a trade at any moment. So sometimes it's important to not force trades, but we can analyze historical data and see roughly, let's say, where I want to place a trade if certain conditions are met. Let's say something happens, a key level is broken, then an indicator and the RSI are all matching. That could be something that you are looking forward to. But you can see quite a significant recovery after a potential double top. We saw a pullback, and at the moment testing this area. Going to be very important to see what happens here. Happy to help. Thank you very much for the question, Leslie. So C. Mitchell asks, when are we going to have Bitcoin back on the chart so we can trade? Unfortunately, Bitcoin and cryptos in general are not allowed by the FCA, the CFDs. So because they are unregulated, we do not offer the CFDs on cryptos in the UK. But where news is always worth following. You can find sometimes news on our platform regarding that. But we unfortunately cannot offer them for the time being on our platform. Yeah, so hopefully that answers your question. It is one of my favorite topics as well, because I find everything in the financial markets very interesting. And yeah, so again, unfortunately, we do not provide that in the UK, but that's not necessarily our decision. It is FCA implemented. So Bitcoin, while a key market and topic, is something that is worth considering as a very, very risky asset as the FCA sees it. So and unregulated, so we cannot offer it here. However, it does play a part, I think, in the gold equation. So it's something that we do offer, which is gold. I think Bitcoin and other assets like that do play a part into gold and the US dollar, because a lot of them tend to be seen as hedges against inflation in addition to gold, although they have outperformed gold in the last while, for sure. Hopefully that answers your question. I know it's not the exact answer that you were looking for, but that's the situation at the moment. Hopefully, perhaps things will change, maybe not. But definitely worth following as well. I actually wrote an article about that today. So yesterday, actually, about that. So it's a topic worth following because it does move markets. A lot of investors are moving it, but on our markets, unfortunately, we cannot do that in the UK. Any other questions? If anybody else has any questions, once again, I'm here to help you, so feel free to ask anything that you might feel maybe a little bit unsure about. Well, it could be anything we talked about today. It could be something, another market that interests you as well. But yes, so let's see. As you can see here, we are on the DAX chart. Let's take a look at oil very quickly. WTI tanking at the moment, breaking past previous lows, and now trading at the lowest level since about a month ago. As you can see here, below $80, breaking below the $80 mark. So a lot of key levels we are seeing at the moment on several assets. This is Brent breaking below 80, and this is WTI once again after the downward gap, pushing even further to 77 right now. Interesting moves on these markets for sure. You can see significant downward move after a consolidation in this area, breaking below the Ichimoku Cloud on the H1 time frame and then pulling back. If you're in the WhatsApp group, you might have seen some of these alerts. So if you're not aware, we do have an XTB WhatsApp group for clients where you'll get news, updates, analysis, some charts, and get reminded of our events as well. If you're not in it, feel free to contact an account manager and let them know that you'd like to join it, and they'll be happy to add you. But besides that, obviously, it's worth considering that there's always something happening, and we try to keep you up to date, both with the WhatsApp, the news section, the calendar we send, and all of the above. At the moment, today we had, as you can see here, WTI falling 2% and unexpected crude stocks falling in the US, which is ironic, which we've seen this, because you would assume that with a drop in stocks of inventory or oil inventories, you would see a rise in price, but at the moment we aren't seeing that. Andy asks, what about gold? Thank you very much. Good question. Gold, here we go with gold. This is on the hourly chart. I think this is a very good level at the moment to look at. Okay, we'll get to Leslie's question as well. I'll read it out loud in a second. Let's touch on gold very quick. So gold, very interesting position at the moment. What you can see here, the blue candles are right here overlaid are the US dollar index. So same time frame, 1 hour US dollar index and gold. I want to show you the long term first, just so you get the idea of what it's usually looking like. So this is on the daily. I know it's a disaster, but look. So if we zoom out, you can see that. Okay, let's do it this way. So if you can see, let's say, okay, let's take away some of these lines. Okay, so traditionally speaking, let's say we've seen an inverse correlation between the prices. So as price gold goes down, or price dollar goes down, gold goes up, gold goes up. Obviously, these are not 100% accurate, and these are not 100%, one-to-one, where it happens all the time and it happens exactly that way. But traditionally speaking, as you can see, this is on the daily chart. You can see they're quite symmetrical. Obviously, sometimes things vary, but overall, the shape is there. So why am I showing you this? It's really to show you then when we do zoom in, what we are seeing in the last few days and the last few, few weeks as well, and few months. We're seeing, as you can see, dollar index rising, gold rising as well. So that correlation seems to be changing at the moment. And on a more, let's say, practical level, let's take a look at where gold is right now. I like to have the Ichimoku Cloud, which is an indicator you can add here on the left, just simply adding Ichimoku. It's this cloud, let's say. It's just a combination of averages, which shows this cloud formation. And generally speaking, the most basic way of seeing it is if the price is above it, it's a positive signal, let's say upward signal. If the price is below it, it's a downward signal. But at the same time, you can see here it breaks below and then pulls back out. So it's not 100% accurate. It's not really something that you would go in on every time, but it's something that you can add to your your ammo of indicators that you use. Yes, so let's take a look at just very quickly here where we are. 1865 level that has been key in the past, but let's draw a support, potential support potential resistance, and then where we are at right now, we can see price reaction area. I'll just even remove these, but you can see a lot of price reaction in the 16 or 1865 region, and slightly higher, but really all around here. At the moment, why am I saying this? Because you can see here that we are testing the upper limit of the Ichimoku Cloud. So sometimes I would send a WhatsApp on this to see that, like, what would happen, what can happen once this is broken. Is it going to affect anything moving forward? Is it going to pull back? Is it going to push forward? But traditionally speaking, even these areas can be considered potentially short-term resistances. Oh, whoopsie. But I can add it again, as you can see here. I'll just give you an example. Here, once again, testing this area. But now if I draw another line here, you can see that resistance, okay, even here, resistance, 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 not really support, and then here now, once again, resistance. So clearly the price encounters some resistance here, but if we go on daily chart, we'll have to see that we haven't broken through this price really since June. So, and then after breaking through this price, we saw a huge decline in the price of gold, where we touched on as well, 11% before consolidating and then pulling back up. So at the moment, once again, gold also testing a very important level, or at least it seems to be important from the past performance. And again, as our disclaimer say, past performance does not equal future, let's say, predictions, but at the same time, you can see that these areas have acted as a reaction area. Next question is from Leslie. I'll also get to your second question, Andy. Just give me a minute. Is insurance companies raising their price a signal that we are getting close to the top? Excellent question. Very interesting question. So could you clarify what kind of insurance companies you're referring to? Are you just referring to any sort of insurance or health insurance, or just what kind of insurance in particular you're referring to? So Andy also asks, there are mixed noise with DXY, bond, and gold going the same direction. Yeah, that's something we are seeing as well. However, I would argue on that gold I feel like has lost some of its, and this is really my opinion, so take that however you want. I think gold has lost in part some of its safe haven status, where people don't traditionally as much see it as a maybe they see it as a longer term cover, but not as an immediate cover against maybe some negative performance in the markets. So that has been lost a little bit. Its correlation with the US dollar seems to be changing as well. If I add it here on the, you can add another chart here on the left, USD IDX. You can see now, once again, pulling back on the US dollar, pushing higher on gold. So it is returning somewhat to similar patterns from the past, but we can see a few breaks here and there. Just because something happened in the past doesn't mean it's necessarily going to happen exactly the same in the future, but it's worth keeping an eye on. So now that we see US dollar pulling back while gold tests this very key level, let's go and take a look at the US dollar index as well. We have it here. So this is a daily chart. Huge push up for the US dollar index at the highest level basically since July 2020, after several days of gaining about 2%, 2.3%. But now we are, if we go on the hourly chart, you can see on the hourly chart, potentially testing, consolidating in this area, which acted as a very brief resistance at the moment, potentially support. But, you know, we have to go back very, very far to find anything else. So past that, we see another consolidation brief here and another one here. So it seems to be a similar pattern repeating. The price moves up, consolidates a little bit and pull back, then moves up a little bit further. But at the moment, we can see this downward pressure really is more significant than what we've seen in the past, because you can see the amount of red candles, the struggle to push back up, an engulfing red candle, a couple of them, engulfing bearish candle. And then at the moment, we are seeing these smaller wicks as well, or these larger wicks with these smaller candles around the 95. Why do I say this? Because going back to the gold chart, and as you mentioned rightfully, the bond chart, which we have shown in the webinar, we are seeing that gold really doesn't seem to be reacting the same way to these stocks and to these valuations. So what could that mean? That could mean several things, of course. But the key thing to keep an eye on is these key levels that we've touched in the past. So regardless of what we talked about past that, on the charts themselves, we can see that this area has acted as a reaction area in the past. We are now approaching or testing the upper limit of the Ichimoku Cloud and previous resistance, while though keeping an eye on the US dollar index, which is pulling back. So if that correlation were to be the same, that could mean something. If it's not the same, that could mean something else. And so I'm trying to just paint a broad picture of the situation we are ourselves in. Okay, so hopefully that clarifies it. Leslie, yeah, let's close it out with this final question here from Leslie. Insurance of properties has been going up. So going back to your question, is insurance companies of properties raising their price a signal that we are getting close to the top? I don't necessarily see that correlation. I do see that insurance companies raising their premiums and their prices is reflecting probably an increase in overall prices. Something that we've touched on as well is the house price index. So that comes out in the UK. I'm assuming you're referring to the UK in particular. The house price index and any other price index for houses and properties, you can see that prices of properties have been really increasing steadily month after month, and we've covered this as well. So that could be in relation to that as well, not necessarily in the greater market picture. But relating to inflation, one of the things that inflation covers is this. So really, it's not just insurance that has been going up. Their price has been going up. It's really everything that has been going up in price. So it's properties, insurance, fuel, energy, basically everything you can think, food, really everything that, as we touched on in the beginning, which is why inflation has become such a huge topic. Yeah, so that's really it, basically, is to close it out that way, I think, is a great way, because we came back full circle with the inflation issue, and inflation is affecting insurance as well, as you can see. So how does that relate moving forward? It could mean that we could be seeing some more decisions by the central banks. It could mean that we could be seeing some certain decisions being made by governments. But at the same time, a lot of these central banks are using work as a metric, so employment figures, not necessarily inflation, as they have been downplaying it as transitory. So hopefully that clarifies it, and I think that's a pretty good spot to end the webinar for today. We ended up having a bit of a longer one, but I don't mind. I really enjoy these. Thank you to everybody who joined. Thank you to everybody who asked questions or just watched. Hopefully it was clear. I tried to illustrate the broader markets, talked about Tesla, we talked about commodities, we talked about a lot of different things. And it's an opportunity for you to ask questions and you to get a little bit more informed. And I think that information and knowledge is the key to becoming really successful in anything you do, particularly trading, because it's not a guessing game. It's not the lottery. It's something that you can study, you can get better at. Of course, nobody's perfect, but we can always get better every day. So that's my goal here, is trying to make you a little bit more informed, get you a little bit better. And if anything else, of course, feel free to leave a like. Thank you very much. Subscribe. We'll see you at the next event. My name is Walid Koudmani, market analyst for XTB. Thank you very much for watching, and good luck with your trading.